Hello guys, we are group 4 and we are assigned to present and discuss the financial management. Here are the terms or topics that we will tackle and you will encounter. The financial management, the taking charge of the company's financial policies and strategies, investments, capital structures, and divided policies, the financial management and control, financial planning, the importance of financial management, also the break-even chart, the financial statements, lastly, the financial ratios. Financial management. Financial management is the process of planning, organizing, controlling, and monitoring an organization's financial resources to achieve its goals and objectives effectively. It involves making strategic decisions about how funds are acquired, allocated, and utilized to maximize profitability and ensure financial stability.
Financial management. Gaining profit is the main goal of businesses. To attain this goal, managers must practice good financial management, and this, of course, start with understanding the financial management functions. These functions include taking charge of the company's financial policies and strategies, investments, capital structures, and divided policies, financial management and control, and financial planning.
Taking charge of the company's financial policies and strategies, investments, capital structures, and dividend policies. Financial managers of organization must formulate sound financial standing plans that will communicate broad guidelines for their financial decisions and strategies. These plans include typical financial policies that address the organization's investments, capital structures, and dividend policies. Investment policy cover choice of product lines and capital projects. Capital structure policy covers a working capital policy for the balancing assets and liabilities, and leverage policy for balancing long-term financing. Dividend policies consider the use of either a systematic pattern of earnings, retention, or dividend distribution.
Financial management and control. The management and custody of the organization funds also include control, which gives an assurance that funds are properly utilized in order to provide for all the organization's needs. Example of financial standard management and control practices by organizations are the following. Project management, which makes sure long-term projects are implemented according to previously planned budgets and checks if these have yield forecast cash returns. Working capital management, which includes cash account receivable and inventory management. Cash management, which gives an assurance that there is enough cash balance that may be used for daily operating needs, that idle cash in invest through marketable securities, and that proper cash control are instituted. Accounts receivable management, which ensures that optimization of account receivable investment and formulation of sound credit evaluation and collection procedures.
Financial planning. Financial planning is the process of setting financial objectives and determining what should be done to accomplish them. This includes financial forecasting, financial analysis, and financial performance evaluation. Financial forecasting involves cash budgeting, a forecast of cash, needs, and sources. Profit planning, a forecast of revenues and expenditures. Balance sheets forecasting. Consider future asset, liabilities, and the organization net worth position. Financial analysis involves capital budgeting techniques, long-term investment. Involve the assessment of long-term investment. Operating leverage analysis. Critically examine cost volume profit relationship. Financial leverage analysis studies the effect of debt on income to the organization common stockholders.
Importance of financial management. Financial management involves making strategic decisions about investment, financial policies, and operations to achieve organizational goals like maximizing profit, shareholder wealth, and addressing border concerns. Example, customer service and societal issues. To ensure success, it utilizes control techniques that assess financial stability, management effectiveness, operational efficiency, and employee morale. A key tool that break-even chart help analyze how different sales level impact income and expenses, identifying the break-even point where costs and revenues balance.
So, to simply explain the break-even chart, as we already know that the break-even point is where revenue is equal to cost. That means that there is no profit or loss is generated. So you can also see the loss area, the profit area, which means in the loss area, mas mataas yung naggastos mo or yung cost kesa sa revenue or kita mo. Sa profit area, mas mataas yung revenue than the cost. So in the margin of safety, this is the horizontal distance between the break-even point and the full capacity output shows how far the company is above the break-even point, giving a cushion against sales drops. The maximum profit, as you can see, it is at full capacity. The vertical distance between total revenue and total cost represent the maximum profit the business can achieve. You can also see the quantity or units in the x-axis, the sales in the y-axis, also the fixed cost line, wherein we already know what fixed cost is. The example of this is the rent or salaries. The fixed costs don't change regardless of how many units are sold. So in the total cost line, so it started in the fixed cost line and slopes upward as production increases. It accounts for both fixed and variable cost. So for the variable cost, for the example of this is the raw materials. So you can also see the revenue line, total revenue line, that shows the revenue generated from sales. And it starts at the origin, which is 0 sales is equal to 0 revenue and slopes upward. And that will be the explanation for the break-even chart. Again, this chart is useful for analyzing sales targets, pricing strategies, and cost management. This is also used by businesses to understand the relationship between costs, sales revenue, and profits.
Financial statements include income statement, balance sheets, and cash flow statement, which are carefully analyzed. Financial ratio. Make use of the above-mentioned financial statement to determine the formulation of a series of ratios that will in turn determine if the company is stable or unstable, strong or weak, and on the road to bureaucracy. Example of such ratio are rate of return on capital invested, rate of return of asset, and rate of return on sales, among others.